On May 14th, Donald Trump will sit across from Xi Jinping in Beijing. You need to understand what that meeting actually is, not what the press releases will say, not what the headlines will call it, what it actually is. It is the most consequential geopolitical negotiation for the global oil market, the dollar's reserve status, and the price of gold since the original petrodollar agreement between Henry Kissinger and Saudi Arabia in 1974. And almost nobody watching it this week is watching it through the right lens. The financial media will cover the tariff discussions, the trade deficit numbers, whether Boeing gets a contract, whether Apple can keep its supply chain. That is the surface. Write this down, because the real story running underneath the summit is a three-way negotiation between the United States, China, and Iran over the future of the Strait of Hormuz. And whoever controls the outcome of that negotiation controls the price of oil for the next decade. And whoever controls the price of oil controls the trajectory of inflation in every developed economy on Earth. And the trajectory of inflation determines what the Federal Reserve can and cannot do. And what the Federal Reserve can and cannot do is the single most important mechanical driver of gold in the modern monetary system. I have spent 40 years watching how geopolitical events flow through the energy market into the monetary system and then into the gold price. What I am about to show you is the complete map of that chain for the May 14th summit. Every link, every mechanism, every historical precedent, and what the historical record says gold does when this specific configuration resolves. Subscribe now. Let me start with what is actually happening in Beijing this week, because the diplomatic sequence leading into the May 14th summit is itself the story that most investors are missing. On May 6th, China's Foreign Minister Wang Yi met with Iran's Foreign Minister Abbas Araghchi in Beijing. That meeting happened exactly 8 days before Trump arrives in China. It was not a coincidence. Wang Yi called for a comprehensive ceasefire. He said the international community shares a common concern for restoring safe passage through the Strait of Hormuz. He said China hopes the relevant parties will respond as quickly as possible to the strong calls of the international community. That is diplomatic language. Let me translate it into the language of interests. China imports approximately 60% of its oil through the Strait of Hormuz. Every day, the strait remains commercially disrupted. China is paying an emergency premium on 60% of its energy supply. China is simultaneously being asked to choose sides in a war between its largest oil supplier, Iran, and its largest trading partner's primary adversary, the United States. That is an impossible position for any country. And China's response to an impossible position is to become the mediator, because the mediator is the one party in a three-way conflict who gains something regardless of who wins. China gains legitimacy as a global power broker. China gains Iran's gratitude and continued oil access at favorable prices. China gains American goodwill in the trade negotiation that is happening simultaneously at the same table. And China gains the most important thing of all in the post-2022 world, where American sanctions have demonstrated that dollar-denominated assets can be weaponized. It gains proof that Chinese diplomatic infrastructure is a viable alternative to American diplomatic infrastructure for resolving global conflicts. That proof, demonstrated visibly on the world stage, accelerates the de-dollarization trend that has been driving central bank gold purchases for 3 consecutive years at double the historical average. The May 14th summit is not a trade meeting with an Iran sidebar. It is a structural negotiation over who mediates global conflict in the post-American hegemony world, and the outcome of that negotiation has direct mechanical consequences for gold. Now, I need to show you the specific oil mechanism, because until you understand it, the connection between a diplomatic summit and the gold price seems abstract. It is not abstract, it is arithmetic. Here is what you need to know. The Strait of Hormuz is a 21-mile-wide passage between Iran and Oman, through which approximately 20% of the world's daily oil consumption flows. 20%. 1 in every 5 barrels of oil consumed anywhere on Earth passes through that strait. Before the Iran war began on February 28th, Brent crude was $75 per barrel. After the strait was commercially disrupted, it surged above $100. That $30 increase is not a market preference. It is a scarcity premium. The physical supply that would have flowed through the strait is not flowing. The world is consuming oil from storage, from alternative routes that are slower and more expensive, and from producers who have increased output to partially offset the disruption. Every week the strait remains closed, global oil inventories decline. Every week inventories decline, the supply buffer that would absorb a further disruption shrinks. Goldman Sachs has calculated an $18 per barrel real-time risk premium already embedded in the current oil price. Wood Mackenzie has warned of $100 oil as a sustained baseline if the closure persists. And here is the connection to gold that most financial commentary never makes clearly. Rising oil prices do three things to the monetary system simultaneously. They push inflation higher, which prevents the Federal Reserve from cutting rates. They strengthen the dollar through the petrodollar demand mechanism, as every oil importing nation must buy dollars to pay for dollar-priced oil. And they force the most financially vulnerable oil importing nations, Turkey, Japan, India, Pakistan, to sell their foreign currency reserves, including their U.S. Treasury bonds, to cover their energy import bills. Each of those three effects is a mechanical headwind on gold in the short term, and each of them reverses when the oil price comes down. When Trump and Xi sit across from each other on May 14th, the central question for every gold investor in the world is whether what comes out of that room changes the trajectory of oil, because if it does, everything else follows mechanically. I want to give you the three scenarios that the May 14th summit can produce, because understanding the scenarios before they occur is the only way to position yourself correctly, regardless of which one materializes. And I want to be honest with you about something before I walk through them. In 40 years of watching geopolitical events interact with financial markets, I have learned one lesson more clearly than any other. The market always overreacts to the scenario it did not expect. It never overreacts to the scenario it was already pricing. So the question is not which scenario is most likely. The question is which scenario the market is not pricing. And the answer to that question changes everything about how you should think about gold right now. The first scenario is a ceasefire framework. Trump and Xi agree on the broad outline of a diplomatic process that would lead to a ceasefire between the United States and Iran within a defined time window. The strait does not reopen immediately, but the market begins pricing the probability that it will. Oil falls from $100 toward $80 as the risk premium compresses. The dollar weakens as the emergency petrodollar demand that has been supporting it diminishes. The Federal Reserve, facing lower oil prices and thus lower inflation pressure, regains the ability to signal a rate cut without fueling an energy-driven inflationary spiral. Real yields fall. Gold responds immediately to all three tailwinds simultaneously. This is the scenario the market is partially pricing right now, partially, because every analyst who covers gold is watching the ceasefire negotiation. What they are not fully pricing is the speed of gold's response when all three mechanical headwinds reverse at once. The 1985 Plaza Accord produced a 50% decline in the dollar against the yen over 2 years. The 1979 oil shocks resolution produced a gold retracement followed by new all-time highs as the structural monetary damage embedded during the crisis was repriced. In this cycle, with central banks buying gold at double the historical average and JP Morgan maintaining a $6,300 year-end target, the structural bid underneath gold when the short-term suppression reverses is more powerful than in any previous cycle. The second scenario is a breakdown. Trump and Xi fail to agree on the framework for Iranian mediation. The summit ends with a joint statement on trade that carefully avoids the word Iran. The strait remains disrupted. Oil stays above $100. The Federal Reserve holds rates. Gold remains in the 4,400 to 4,800 range, while the structural buyers, the central banks, the long-term institutional allocators continue accumulating quietly at prices that JP Morgan's research department has already identified as the structural accumulation floor. This is the scenario the market is currently pricing as the base case. It is not bearish for gold. It is a continuation of the current configuration. The structural bull market does not require a ceasefire to continue. It only requires the fiscal and monetary conditions that created it to persist. And those conditions, 39 trillion in debt, 1 trillion in annual interest payments, 40 billion per month in reserve management purchases, are not going anywhere regardless of what happens in Beijing. The third scenario is the one the market is almost entirely ignoring: a comprehensive agreement. Not just a ceasefire framework, but a structured deal that includes Iranian nuclear program constraints, a Hormuz navigation guarantee, and a diplomatic normalization process that China commits to facilitating and guaranteeing. This scenario would be the most significant geopolitical development since the original Camp David Accords. It would produce a rapid compression of the oil risk premium, a sharp dollar decline, an immediate repricing of Federal Reserve rate cut expectations, and a gold correction of potentially 15 to 20% in the short term as the mechanical headwinds that have been supporting the dollar and suppressing gold simultaneously reverse. But here is what the historical record says about that correction. It is the best buying opportunity the structural gold bull market will produce before its next major leg higher, because the underlying fiscal arithmetic that is the structural driver of gold does not change when oil goes from 100 to 75. The 39 trillion in debt is still 39 trillion. The 1 trillion in annual interest is still 1 trillion. The central banks that have been buying gold at double the historical average for 3 years are not selling because the Strait of Hormuz reopened. They are buying because the structure of the global monetary system has changed in ways that are independent of any single geopolitical event. Now, I want to show you the China dimension of this story specifically, because China's role in the May 14th summit is more complex and more consequential for the long-term gold thesis than any of the Iran-specific analysis I have seen in financial media this week. China imports approximately 60% of its oil through the Strait of Hormuz. That dependence is not a weakness China will accept indefinitely. It is the primary strategic driver behind China's 30-year project to build alternative energy supply chains, pipeline infrastructure through Central Asia, and diplomatic relationships with every major oil producer outside the American alliance system. The Iran relationship is central to that project. Iran holds the fourth largest proven oil reserves in the world. It shares a land border with China's strategic partner, Russia. It controls the strait that China's entire eastern seaboard economy depends on for energy. And it has been systematically excluded from the dollar-denominated international financial system by American sanctions since 2012. That exclusion has made Iran entirely dependent on alternative payment mechanisms, yuan-denominated oil trades, gold for oil barter arrangements, cryptocurrency clearing systems that bypass the SWIFT network. Every one of those alternative mechanisms strengthens the infrastructure of the parallel monetary system that China has been building alongside the dollar system since the American financial sanctions of 2012 demonstrated that dollar access can be used as a geopolitical weapon. When China mediates between the United States and Iran at the May 14th summit, it is not acting as a neutral broker. It is acting as the architect of a post-dollar energy settlement system that serves Chinese interests regardless of the diplomatic outcome. If the war ends, China gets credit for the mediation, and Iran remains within China's economic orbit on favorable terms. If the war continues, China continues to purchase Iranian oil at a discount to market prices and continues to build the alternative settlement infrastructure that every sanction-vulnerable country in the world now has an interest in joining. The May 14th summit is the most visible moment in a structural process that has been operating since 2022. The process is the construction of a parallel global monetary system in which the dollar's role as the exclusive medium of energy settlement is progressively reduced, and the asset that benefits most from the progressive reduction of the dollar's monetary monopoly is the same asset it has been in every previous monetary transition in history: gold. Not because gold is a trade, because gold is the only monetary asset that exists outside the dollar system, outside the yuan system, outside every national monetary system simultaneously. Let me close with what I am personally watching most closely between now and the close of the May 14th and 15th summit sessions, because these are the specific signals that will tell you which scenario is materializing before the headlines do. The first signal is the oil price in the 48 hours following the summit's conclusion. If Brent crude falls below $95 in the immediate aftermath, the market is pricing a ceasefire framework. If it falls below $85, the market is pricing a comprehensive agreement. If it stays above $100, the summit has failed to produce a meaningful Iran outcome. The oil price will tell you more about what happened in Beijing in 48 hours than any diplomatic statement will tell you in 48 days. The second signal is the dollar index, the DXY. The DXY is currently elevated above 99, mechanically supported by the petrodollar demand created by the Hormuz disruption. When that disruption begins to resolve, the emergency dollar demand that has been supporting the DXY diminishes. Watch for the DXY to break back below 97. When it does, the primary mechanical headwind on gold prices begins to lift. The third signal is the Federal Reserve's language. If the summit produces a credible path to lower oil prices, the Fed will face an environment in which the inflationary pressure from energy, which has been the primary justification for its hawkish hold, diminishes. Watch the Fed funds futures market in the 72 hours following the summit. A shift in the probability distribution toward a 2026 rate cut, even a small one, is the signal that the monetary mechanism that has been suppressing gold is beginning to turn. The fourth signal, and this is the one that almost nobody is watching, is the Chinese yuan gold price on the Shanghai Gold Exchange. Chinese institutional investors price gold in yuan. If the yuan gold price surges in the days following the summit, it means Chinese capital is flowing into gold as a hedge against the geopolitical outcome, regardless of what the dollar gold price is doing. That signal tells you what the most sophisticated sovereign capital allocators on Earth, operating in a market the Western financial press rarely covers, have concluded about the summit's implications for the monetary system. Watch the dollar gold price for the trade. Watch the yuan gold price for the structure. They will not always agree in the short term. In the long term, the structure always wins. There are two types of investors watching the May 14th summit. The first type is watching the tariff headlines, the trade deficit numbers, the Boeing contract, the photo opportunity. They are watching the surface. The second type understands that Trump and Xi sitting across from each other in Beijing on May 14th is the most consequential moment for the oil market, the dollar, the Federal Reserve's policy options, and the structural trajectory of gold that has occurred in 2026. They are not watching for a trade. They are watching for confirmation of which phase of the structural gold bull market the summit's outcome places us in. In 40 years, I have watched every major geopolitical summit that intersected with the monetary system. The investors who understood the mechanism before the summit concluded were always better positioned than the investors who waited for the headline to tell them what had happened. The mechanism is already running. The summit is in 3 days. Now you understand what to watch for.